Good evening, everyone. Welcome to our Oklahoma State Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for joining us for tonight's session. I know we have a few of us kind of trickling into today's session, so we're a couple minutes past the hour, but I just want to kind of talk a little bit about housekeeping for tonight. Tonight is a very interactive session, so as we go through tonight's content, we'd encourage you to ask questions of us. We try to make this a very interactive session. Our run time for tonight's call or session will take us right up about to the top of the hour. So depending on what time zone you're in, I know we're in Central. We're getting started about 7 o'clock, but we'll wrap up this by 8 o'clock. We are recording tonight's session as well. So this session will be up on our YouTube channel tomorrow. So you can get a chance to look back at some of your notes or kind of review some of the content again. We're also sending out all of the presentation material tomorrow morning as well. So you'll be able to kind of check back and take a look at this. Well, we're excited to bring this workshop to you because this is our second installment of 4 workshops for our Oklahoma State Alumni Association. And, we really appreciate the support of the association, love our partnership, and really look forward to that growing over the years. But our organization, American Pacific Mortgage, is a nationwide lender. And I teach classes like this through 15 different partnerships with different alumni associations all across the country. So whether you're in the Oklahoma market or you're on the East Coast or the West Coast, we can help support you on your path towards homeownership. And we essentially teach classes like this to provide you all the resources and ultimately the knowledge that you need to make what is probably going to be one of the biggest financial decisions you decide to make. So these classes are free for you to attend. And if you enjoy tonight's content, we'd love for you to be able to share this with friends, family, maybe even coworkers that might enjoy learning a little bit more about what homeownership could look like. And really, at this point in the market, we're currently in the spring buying season, which generally in most parts of the country is where more buyers are active. So I think taking time out of your busy schedule on a Wednesday night, especially coming out of a 3-day holiday weekend, I think this is going to be really good information to help you kind of understand what's going on in the market. And certainly whatever your timeline looks like for home buying, this should be a great course to help kind of prepare you for taking that next step. Well, if you have any questions as we go through tonight's content, feel free to use the chat feature or the Q&A within Zoom, and then I'll go ahead and answer any questions that you have. And I know we got a couple questions already come in the chat. Like I mentioned earlier, we're going to record tonight's class and then send out the slides out to you tomorrow. So that's what we have in store for tonight. Really excited you'll be able to join us. So let's go ahead and dive in and talk a little bit about tonight's discussion points. So we're going to talk a little bit about the housing market, kind of what's going on across the country. We'll kind of spotlight a few states as well, including the state of Oklahoma. We'll also talk a little bit about interest rates and what are interest rates doing today in the market. We'll also spend some time looking at renting versus buying. So when we think about budgeting for homeownership, how should we be thinking through that? And what are all the factors that make up buying and really the benefits of owning a home? We'll also spend some time looking at credit and how to have ourselves prepared with our credit to be able to be in the best possible position to purchase and have the lowest options from a financing perspective. And then we'll also take a look at some of those financing options. We'll look at about 5 or 6 different loan programs that are available to you as home buyers. And then we'll talk a little bit about saving up for home ownership. So how do we prepare for down payment as well as closing costs that are involved in buying a house? We're going to give you some tips around savings for home ownership, which would include looking at access to various first-time homebuyer programs that are available across the country. And then from there, we're going to transition into the buying process. So after tonight's call, you may say, hey, Jason, I want to really kind of start my path towards homeownership. Well, I'm going to share with our class what that kind of path looks like for you. We call that our 6 steps of home buying, to go from our classwork to actually getting qualified for a mortgage to eventually at the very end of the process, getting our keys to our home. So we'll walk through the buying process, and we'll also talk a little bit about what consulting for homeownership might look like for you, which is a free service that we provide to our communities. Well, let's talk a little bit about what buying might look like for you, because, does buying make sense for me is the question we have to ask ourselves, because, again, this is probably going to be one of the biggest financial decisions you decide to make. So the fact that all of our class is taking time out of your busy schedules on a Wednesday night obviously shows us the importance that you have on this bigger financial milestone for you. And when we think about homeownership, there's a lot of great benefits that come along with it, like I should be able to create better affordability for myself, or control, at least from a housing budget perspective, because I know every month what I have to pay in my housing expense versus having to worry about maybe your landlord that is increasing your rent as you renew each year for your rent schedule. Now, as clients consider buying in today's market, we are at elevated rate levels, which we're going to talk about later on tonight. But ultimately, at some point in time, a client will have an opportunity to refinance their home, which is essentially lowering their interest rate when the market supports that, to be able to help improve their overall monthly payment. So you can do that when you become a homeowner. And this is an asset that should grow over time. So as my home goes up in value from my date of purchase, and as I pay down my balance, the difference between those figures creates home equity. For most of us across the country, that's our number one asset that we have. And so this asset has the opportunity to create generational wealth for families all across the country. And there is some tax benefits that come along with owning a home, potential tax benefits around deductibility of interest, as well as potential tax benefits that exist when you do energy efficient upgrades to your home. So when we're thinking about home ownership a little bit further, and is it right for me, I always encourage clients to think through all of those characteristics that make up home ownership, because truly it's not really an apples to apples comparison. So to help kind of illustrate that point, I thought we could spend some time talking through a rent versus buying calculator that we're going to share with you in our slides that go out to you tomorrow as well. And this kind of allows us to kind of side by side compare looking at renting versus buying and what could it be for me. So for this portion of our class, I'm going to walk you through this rent versus buying calculator, just so you can get a sense of like, how do we think through home ownership a little bit more. And so this calculator tool is brought to us by Freddie Mac, which you're going to learn a little bit more about what Freddie Mac role in home buying can be around conventional loans. So let's take a look at this calculator and what it looks like. So we just put in a what if here of someone buying a $300,000 home. Minimum down payment is 3%. Now we're going to talk a little bit about down payments in our product segment, but minimum down payment is 3%. Then we factor in property taxes that we pay to our local county assessor's office. We factor in homeowners insurance for the home, and as well as maintenance costs. So those all go into the equation of the buy side, right? Well, when I buy a home, and of course we're going to probably use financing, we have to factor in the financing mechanism, which for most of our buyers, it's going to be a 30-year fixed mortgage. Then we plug in an average interest rate, which we'll talk about tonight as well. Average interest rate right around 6.875%. We have origination costs for purchasing my home. Now, one of our benefits that we pass along to our Oklahoma State Alumni Partnership is that we actually discount our origination charges by $750, ultimately to create better financing options for our partnership. And then there are discount points that you as a buyer can elect. Essentially, when you take out discount points, you're basically paying more money out of pocket in order to bring down that interest rate. Usually one discount point is the equivalent of 1% of your loan amount, and that can generally bring down my interest rate about 0.25% for my home financing. Now, in today's market, I don't really recommend clients contributing to discount points because usually it takes about 3 to 4 years to break even on those types of investments. Now we have other settlement services. Those include title, escrow fees, maybe attorney fees for my home purchase. All those get factored into that number. And then the last section is other assumptions. So we assume that our home will appreciate about 4% on an annual basis. Now that can vary based upon where we're at in the country for our home purchase. That we're going to be in our home for at least 7 years. And then we have the selling costs of our home at the end of 7 years. So if we look at the end of 7 years, now I've sold my home, and then what it looks like from a rental perspective. We have state and federal tax rates as well as the savings rate. Now that savings rate, we could probably argue that should be higher, but for this exercise, we'll kind of keep it at more of a nominal level. So in this calculator, we can see the side-by-side comparison. So we have our $2,000 a month in rent. Now from a home ownership perspective, we're going to have to anticipate that home ownership budget's going to go up. So we're looking at spending now $2,700 a month versus $2,000 a month. However, if I was to look at my total cost opportunity over 7 years by owning versus renting, my buying opportunity creates about $63,000 up on the upside of owning versus renting for the next 7 years. And how I get there is through the tax deductibility opportunities that exist as a homeowner, as well as my appreciation that comes about as owning my home as well. So clearly there's some huge upside with ownership. Now it depends on the situation a client is in, but ultimately this is a great calculator to walk you through the potential benefits of owning, but also understanding like maybe I need to continue to rent because ultimately maybe I'm not in the financial position to purchase, but this is a great guideline to help you understand a little bit more about what it looks like in that comparative analysis. All right. So we're going to send that calculator over to you so our class can check that out. That'll be part of our presentation material. As we kind of talk through more aspects of home buying, we want to obviously look at the housing market and what's going on with it. Now, this market's a bit interesting right now. I'm getting a lot of data coming in that's really helpful for me in teaching classes. Because as we look across the country, we're starting to see more and more price reductions out there. Some markets are seeing more inventory that's staying on the market. Depending on what part of the country you're in or where you're thinking about buying. If we look at Florida, Texas, Colorado, Georgia, just to name a few states, we're seeing inventory levels that they're having year over year increases in inventory, which basically things aren't selling as fast. We're also seeing some of those states with the largest price reductions as well. So we're seeing states like Texas with like 22% price reductions on average, or I'm sorry, 22% of all transactions seeing price reductions. So there is some opportunity in today's housing market when there's a bit of an uncertainty that could present opportunity for some buyers that are financially fit and ready to enter today's market. Now, if we were to look at the Oklahoma housing market specifically, let's kind of look at some of the data sets here. So we have an average or median price of 251,100. You can see our prices creeping up a little bit. So good news there. We are currently in the spring buying season right now, so more buyers are active because, let's face it, it's warmer in most parts of the country. Sellers are going to start putting their homes on the market because, the grass is green, maybe the snow has melted away, whatever the case may be. So we're seeing more inventory come on the market, especially after Memorial Day weekend. We see things tend to pick up in our industry quite a bit. More sellers are putting homes on the market. And I think that's why you're seeing a little bit of a backlog in inventory right now. So we're seeing more inventory into the market, but maybe not all buyers are ready or maybe prepared out in the market to purchase. So, there's maybe a little bit less competition out there. There's a few more choices in most parts of the country for buyers. So I think there's some really encouraging signs for first-time buyers when we're thinking about this housing market. Another kind of interesting data piece in today's market is that 44% of all transactions being done across the country right now include some type of seller concession, which basically the seller is saying, hey, we're going to concede some of our proceeds of our home sale to help you out with closing costs for your home purchase. So we're seeing that in all parts of the country in the communities I support in home ownership. So it's a very interesting time right now. So like I said, in today's market where there's maybe some uncertainty from an economic perspective, I think there is some opportunity, especially for buyers, to enter the market if they're financially ready. Now, part of that readiness and, ultimately their buying power or budget is centered around what's going on with interest rates. And so interest rates are a big topic of conversation in my work with clients. And so when we look at interest rates, we're still at elevated levels in today's market. If you look at the last 12 months that we have on screen, we're right around that high sixes. Sometimes we've touched on the 7% level. Doesn't look a lot different than what we saw 20 years ago. Now, keep in mind, 20 years ago, homes were just a fraction of the price we see today in most parts of the country. But why we're here at current elevated interest rate levels is the Federal Reserve has ratcheted up the federal funds rate in order to combat inflation, which you and I are facing inflation every day, right? We go to the grocery store, things are just more expensive, costs more to put gas in our cars, all that stuff we're facing. Now, inflation is starting to decrease, and at some point we will see the Federal Reserve start to cut rates. It's probably not going to happen next month, but we are seeing signs that the Federal Reserve will have to make a move on interest rates as inflation improves. There's two kind of metrics that the Federal Reserve is looking at. They're looking at us hitting inflation of 2%, so that's the mandate. And then they're looking at a strong labor market and unemployment rates to be lower. So those are, kind of the guidelines for when we see the federal funds rate start to come down or be cut by the Reserve. Now, when we think about that rate cut that will eventually happen, it doesn't necessarily impact directly mortgage rates, but it will have a ripple effect into interest rates. When we see the federal funds rate cut, that will immediately impact credit cards, personal loans, car financing, bring down the cost of or what you're getting in high yield savings accounts, that kind of stuff. But it will help improve interest rates, and interest rates will start to trend down over time. I think in 2025, we're still going to see interest rates at elevated levels. And then as we move into 2026, we'll probably see interest rates in the low sixes. And then as we move further along, hopefully rates will continue to drift lower. This is a very fluid situation in interest rates. We are truly a global economy, so interest rates can change, based upon some news in Europe that could impact interest rates here at home, maybe an inflation reading comes in higher than expected there, that could impact us at home. So we are truly kind of interconnected from a global economic perspective. Now, when we think about interest rates, there's various factors that go into interest rates, things like credit score of our client, eligibility for a loan program, the type of program I'm going to do, what my amount finance looks like, how much do I think I'm going to put down for down payment as a percentage of my sales price. We talked earlier about buying discount points. We're essentially buying the rate down by investing additional cost out of pocket. So again, 1% of your loan amount equates to about a 0.25% reduction in interest rate. And then generally the term of my loan can also influence my interest rate. So traditionally, especially as first-time buyers, we're going to be using a 30-year fixed mortgage product. But if I decide to shrink that down to maybe a 20-year loan or maybe even a 15-year loan, that's going to help reduce my interest rate. Now, as I get a chance to meet with our clients after class and we kind of figure out like what's the right options for you around home buying, we're going to tailor the right product that meets your financial goals around home ownership. As we think about doing that, we're going to explore credit, right? Because credit is one of those drivers we talked about with interest rate just now. So we really want to make sure we're financially ready when it comes to credit and preparing for home ownership. So in this part of class, we always like to talk a little bit about some of the aspects around credit so you can maybe look at some opportunities to help your own improvement of credit score. Now, each loan program has various minimum credit score levels. And so you can see those on screen here with the FHA loan at 580, conventional loan at 620, our VA home loan for our veterans at 620, and then for us that are going to purchase in more rural areas, 620 for the USDA product. So each loan product is going to have those minimum credit score. Now, when we look at the credit score system, there's 3 different agencies, right? There's Equifax, Experian, and TransUnion. All of those agencies report different scoring. Now, we always take the middle score of all 3 bureaus. So if my top score is 780, my middle score is 760, and let's say my lowest score is 740, we're going to use 760 for the qualifying for that scenario. Now, let's say, for example, my partner is going to join me in my application, but my partner's credit scores are slightly lower. Let's say they're at 720, 700, and then 680. Well, my partner's lowest middle score is the one that we would take in that scenario because we're applying jointly. So we would use 700 for the qualifying score. That's important to understand because, you know, we want to kind of strategically manage through credit with you and figure out the best way to set up your financing. Maybe it's something where we're just applying in just your name because your credit score is higher, if that's giving you the buying power that you're looking for. Because ultimately, credit score will influence interest rate, mortgage insurance, and then the type of product that you're going to elect for your home financing. Now, we're going to talk through things like credit utilization. How do we manage credit card debt? We're going to spend some time briefly looking at account closure. When we think about how long things are going to appear on our credit report and impact our credit score, it's usually in the most recent 12 to 24 months. Now, how it's going to stay on my credit report or how long it will stay there as an impression on my credit report will be dependent on the item. And you can see this matrix here that kind of shows you how long negative items will stay with you on your credit report. Ultimately, within the recent 12 to 24 months, that's where the impact will be in the credit score. So let's say I have a late payment on my student loan in October of last year in 24. Now I'm still inside of 12 months, so I'm probably seeing a little bit of an impact on the credit score. But as I move further and further away from 2024, let's say I get to November of 25, I probably see a little bit of an increase in my credit score. So, you know, that's how we want to think about like events on my credit score. Now, as I get more severe in terms of if I have a 90-day late on my credit score versus a 30-day late on my credit score, that can change the level of my credit score. Okay. Now, this screen kind of shows you what the weighting looks like in the credit score system from a mortgage perspective. Now, there are 3 different credit risk models when it comes to scoring. There's the credit card model, there's a auto financing model, and then there's mortgage. Now, for those of you that are using consumer monitoring systems, like let's say Credit Karma or Experian or anything like that, those systems use the credit card model. And so when you look at that score that appears in those services, it's going to look probably a little bit different than the mortgage model because the risk assessments look a little bit different. Here's what the weighting looks like in the mortgage score. So 15% is going to be how long have I had credit? So the more mature my credit file is, the higher my credit score is going to be. So if I had credit for the last 6 months, versus someone that has credit for the last 6 years, that 6 year credit history is going to show much stronger. Now, as I grow in depth of credit, that score will organically grow as I have more maturity in my credit profile. Now, if I'm trying to open up new credit cards or I'm having creditors access my credit through a hard credit inquiry, that's going to impact the next area, which is in use and new credit, which is 20% of the credit score weighting. So we really want to avoid opening up a lot of new accounts in a recent span of time, especially within a 6-month span of time. And we really want to avoid hard inquiries. So that's when a lender has access to your credit and now reports a hard inquiry. Now, in working with our team in designing your home buying plan, we choose to only start with a soft credit inquiry. The reason why we try to do that is because I primarily work with first-time buyers across the country, and various buyers are at various timelines of buying. So we want to give you some guidance and understanding of what your opportunities look like in home buying, but not impact your credit score. So if you decide to consult with us for your home buying options, we're only going to start with a soft credit score. Now, there is a rule in the mortgage score reporting that states that you have a 30-day window of time if you have a lender that does a hard inquiry to shop around with as many lenders as you want to. And it's the equivalent of one credit inquiry hit to your score. But again, working with our team, we always start with that soft inquiry because we really just don't want to put that in play of any type of hard inquiry to your credit. Now, the next component is how much do I owe from a revolving credit perspective. So we call that credit utilization, where we're essentially looking at your credit limits versus your credit balances. So if I have, let's say, $5,000 in credit balances today and my credit limits are $10,000, right now I'm at 50% utilization. Now, if I just charged up a new vacation to Cabo and now my balances are at $8,000, now I'm at 80% utilization. If I did that, I'd probably see a little bit of pullback in my credit score. Now, ideally, we want to have those credit card balances at 10% or less of the credit limit, which would be $1,000 in this example I just gave you. Now, if you, let's say, are running 80% utilization in credit, our first step that I would say is try to get those credit cards paid down to 50% utilization. Once we've gotten to that level, let's work towards 30%. And then the ultimate goal being to 10% utilization. That's where we're going to see clients that are at the higher credit score levels, like the 800 plus credit score amounts. Now, here's a quick tip to how to manage credit card debt. So if you were to take a look at one of your credit card accounts, there's two important dates on those credit card statements. There's one is the billing cycle or statement date. The other date is your due date. Here's why I kind of share that with you. If you look at the billing cycle and statement date, that is the date at which all the credit activity gets closed out by the credit card company. And what they do is they report all your activity out to the credit bureaus, what your credit limit is, what your balance is, how you paid your bills, right? So if you could pay down that balance or pay it off ideally before the end of the billing cycle date, what you're doing by changing up that approach is you're actually pushing out a lower balance to the credit agencies, therefore lowering your utilization and then lifting your credit score. Especially as you're preparing for homeownership, I would really encourage you to try to pay down credit card debt. It's just going to obviously create better opportunities for you when it comes to scoring higher on the credit side of things and ultimately improving your financing options. And during our consultative process, we'll help you through that. So don't feel like you have to come to us with debt paid down already. We can coach you through strategically what things we would recommend paying down for you in planning for homeownership. Last component is going to be payment history. That's pretty simple. How have I paid my bills? If I've had any late payments, we're looking at rating those as 30-day lates, 60-day lates, and then 90-plus day delinquencies. More severe on the spectrum of lates, the bigger impact it's going to have on my credit score, especially if I've had late payments in the last 12 to 24 months. I made that example of a student loan late payment from October of 24. So that's going to have a bigger impression on my credit score than, let's say, a late payment from October of 2020. All right. So that kind of shows you how the FICO score calculation is built. Now, when we think about credit, we're always going to examine what appears on the credit report, which for most of our clients that I work with, especially through our partnerships, could include student loan debt. And right now we've seen a lot of the federal student loan payments come back online. So we were kind of in a little bit of a limbo situation where, a lot of federal student debt was in a kind of a forbearance situation because of pending litigation for forgiveness of debt. Sounds like some student loan payments are going to come back online in June or July. So That changes things up a little bit for clients. But how we approach this in reviewing this for lending is a couple different ways. Now, if you're in forbearance right now, in lending, we still have to count a minimum payment for you in qualifying. Even if you're in a deferment status, so maybe you're back in school, we still have to count monthly payments into the qualifying for a mortgage. So let's say you're on an income-based repayment program or a savings plan with $75,000 in student loan debt, then I would have to count 200. If your payment's $250 per month, I would count $250 per month as the monthly payment for qualifying purposes. So if I'm in active repayment right now, we can use that $250 per month payment. Now, if I'm still in forbearance or deferment, then I can't use the income-based repayment. If I am in forbearance or deferment, then by default, as a lender, I have to use either 0.5% of those balances on the student loans for an FHA loan, which would be $375, or for a conventional loan, I would have to use 1% of the balances, which would be $750 as the payment. So that's how we would look at it from a lending perspective. Now, if you're in, a public servant position where you're working in your local community in a public forgiveness, I should say, program for student loans. If that usually those have a 10-year cycle, even if you're on a program like that, because it eventually will be forgiven, we still have to count a monthly payment today if there's existing debt. Okay. Now I think with the student loans coming back online with payments, that is making things a lot easier from a lending perspective, because as things were kind of in this kind of gray area, we didn't really have a direct path forward to have that lowest payment count for clients. But now we're kind of starting to see some of those payments come back online. All right. Before I jump into loan programs, I just want to kind of take a quick pause here for any questions. I know I was kind of rattling off a bunch of concepts. I want to make sure that I answer any questions. And you can ask me those questions by using the Q&A or chat function in Zoom, and I'll certainly answer those on air. But before we jump into the product section, I figure I'd just take a quick little pause for our group. Okay, I think we're good. Okay. All right, I don't see any typing away, so we'll keep it moving. So let's talk a little bit about loan programs that are available to you. Now, you see a bunch of different stuff online, and it may be a little bit confusing because you're like, okay, what's the right fit for me? So I want to give you kind of a little bit of a high-level look at each one of these loan programs, which you've probably heard some of these terms before. The first one is a conventional home loan. So I mentioned Freddie Mac as part of one of the calculator resources for us. So Fannie Mae and Freddie Mac, you might actually see them in the news right now because there's talks about the new administration taking them outside of conservatorship and privatizing Fannie Mae and Freddie Mac, which we'll see what happens with that. But ultimately, they're kind of under conservatorship from the U.S. government, FHFA, just because of kind of the changes that happened in the housing market back in 2008. But we'll see if they privatize Fannie Mae and Freddie Mac. They ultimately account for about 60 to 70% of all originations done across the country. The minimum down payment on a conventional loan for a first-time buyer is 3% of the sales price, all the way up to a loan amount, which is called the conforming loan limit of $806,500. Now, the minimum credit score for the conforming loan for a Fannie Mae or Freddie Mac loan is 620. And then depending on where you're joining us from, if you're in different parts of the country, like let's say California or Virginia, there are various high cost of living areas that allow us to take that maximum loan amount beyond 806,500. In fact, it goes up to almost $1.2 million, or at $1.2 million, $1,290,000. That minimum down payment moves from 3% to 5% when we go into those high balance areas. So there's a little bit more bandwidth there, but the down payment increases. The next product is the FHA home loan. FHA stands for the Federal Housing Administration. That is a government insured loan. It's a federally insured loan. Minimum down payment of 3.5%, minimum credit score of 580. Maximum loan amount does change a little bit depending on what county you're going to buy in the country. So we've just placed a county here in Oklahoma, but ultimately it does change based upon what parts of the country you are in. FHA is a federally insured loan, so there's a little bit more flexibility, not just from a minimum credit score perspective, but overall underwriting guidelines. Now with FHA, you may have seen a little bit in the news, there is some changes with eligibility. So unfortunately, you have to be a permanent resident in order to have access to both the FHA and another government insured loan, the USDA loan. So That is just for permanent residents today. Now, non-permanent residents can still take advantage of the conventional Fannie Mae Freddie Mac loan, but today FHA and USDA, you would have to be a permanent resident. I saw a hand raised there by Martin. So Martin, if you have a question in the chat, feel free to drop that in. And then we're going to talk a little bit about the difference between conventional loans and FHA loans in just a minute. We're going to spotlight mortgage insurance, which is a concept that there's a little bit of confusion around that. So we're going to kind of teach you through what mortgage insurance looks like on both conventional and FHA. Next product is a jumbo home loan, which honestly is not super popular for first-time buyers. That allows more financing resource if you need to stretch beyond some of the conforming limits or the high balance limits across the country. It does elevate the minimum credit score to usually 680 to 700 and does increase the minimum down payment from 10 to 15%. Or from 3% to 10 to 15% usually. Now, the next product is our VA home loan for our veterans that have served. The VA home loan product has a 0 down payment option for the veteran, minimum credit score of 620. There really isn't a maximum loan amount for the VA home loan product. We can go to high as $5 million. So there's a really wide range for the veteran purchase. This product allows more flexibility and support for the veteran to have an entry point to home ownership. And you do have to have VA eligibility to take advantage of that product. The next product is the USDA home loan. That is a government insured loan, as I mentioned earlier. It stands for the United States Department of Agriculture. So you guessed it. That's for clients that want to purchase in more rural areas. There's two major qualifiers for USDA. Has to be in a rural area designated by USDA. It also has maximum income qualifying based upon the household size. And the maximum loan amount does change by the location. We have just an average county loan limit of $398,600 for Oklahoma, but it does change based upon where we're going to buy across the country. So those are kind of a snapshot of what some of these loan programs look like. Now, I want to do a quick little snapshot, if you will, looking at what mortgage insurance looks like. Now, before I transition to that topic, question that came in the chat, which is it better to have a down payment or is it the same as full financing at the end of the day? Maybe I think that may be a bigger down payment. So, when we think about making offers on a home, is it better to have a larger down payment or to finance less or more, I should say? Really just depends. I mean, strength of buyer looks differently in different markets. Some markets, it's like we have to have 20% down to really feel like we're competitive. But I think this market is switching up a little bit. We have success with buyers who are putting the minimum down payment of 3%, as opposed to maybe, other clients that feel like they have to put 20%. At the end of the day, I think for our clients, when it comes to not just their competitiveness in the market, but what the housing budget or affordability level needs to look like and what resources they have, we're going to figure out what the right combination of sales price, down payment, of course, what the interest rate looks like at that time to make sure that we're hitting the mark from a monthly budget perspective, because ultimately that's kind of the most important thing, if you will, in designing a home buying option. All right. Thank you for that question. I want to explain to you a little bit about PMI. You've probably heard about this topic. There's a lot of misconceptions around PMI, but PMI stands for private mortgage insurance. So that is part of a conventional home loan product. There's also MIP, which is mortgage insurance premium. That has to do with an FHA or government insured loan. So I'm going to kind of explain both and how those work. Now, ultimately, mortgage insurance as a whole provides insurance for the lender in case there's default by the buyer. So if there's an economic hardship, for example, from a buyer couldn't afford their home, the lender would be protected against any type of default by the buyer. Now, it is paid for by the buyer as part of their home financing. On a conventional home loan, PMI is based upon what my down payment looks like, what my credit score looks like, and then how much I'm going to finance. So the more I can put down, the higher my credit scores, the lesser the cost of my mortgage insurance is going to be. Now, one of the benefits of using a conventional loan and that PMI is it does have a cancellation option. So once I have 2 years in my loan and 22% equity, I can apply to have that mortgage insurance canceled. Now, I will say for some of you in class that have already started your home search on Zillow or Redfin, you may be kind of taken back by maybe the cost of premium showing for PMI. Those calculators that I've found online don't really show PMI properly. Generally, when we look at the PMI calculation and we apply that down payment, credit score, and loan amount, it doesn't look as significant. So like if you looked at it, a loan amount financed of, let's say, 250, and you had a credit score of 740 and you're putting 3% down, the mortgage insurance is like $85 a month. So it's not as, significant as you might see in some of those calculators online, again, driven off of some of those features that we discussed. Now, FHA looks a little bit different because FHA has two components to mortgage insurance. There's upfront mortgage insurance, which is always 1.75% of the loan amount. And then there's monthly mortgage insurance, which is 0.55% of the loan amount. And then we divide that by 12 months to make up our dollar figure that we have to pay for on a monthly basis. Now, FHA mortgage insurance cannot be canceled. It has to be refinanced out. So, we really use FHA as kind of that opportunity to access home ownership, especially for our clients that maybe have had some credit challenges or maybe, not quite at the credit score level that they would like to be. FHA is an awesome resource to get into home ownership, but we're probably going to use that as the loan option for the next 2-3 years. And as I improve in credit score, as maybe my equity grows in my home and maybe interest rates cooperate, we would look to refinance into more of a conventional home loan product. Now, if we looked at FHA with those two forms of mortgage insurance, we have the upfront mortgage insurance. So we take that same example of 250 in loan amount financed. We take the 4375 that has to get added in on an FHA loan, and then the monthly mortgage insurance is 116 a month on FHA. So the expense structure is a little bit different from FHA to conventional, but I think it's important to understand in classes that not everybody is going to qualify for a conventional loan. While we would love to have all of our clients qualify for conventional because it is a lesser cost option, FHA is going to be another option for our clients that need that resource to be able to have that access to home ownership. Now, as we meet with you for a consultation, we're going to figure out what the right design for you looks like and figure out which product, whether it's the USDA, VA, conventional loan, FHA, maybe even the jumbo loan product as we design your home buying plan. Now, one of the things we're going to have in our conversation is to discuss what your income qualifying looks like relative to the price of home that you're looking for. Now, in lending, we always have to validate things that are on the application, things like your income, of course, your credit. This is a quick little documentation checklist, if you will, that generally are some of the items needed in the process. So especially for a W-2 employee, last 2 years of W-2s, last 60 days of pay stubs, and then we're going to verify asset statements. All right. So that's kind of what that looks like. Now, I want to kind of explain to you a little bit more around income and how we view that from the lending perspective. So we always have to look at the last 2 years of employment or educational history. And I like to point out the educational side of it because especially for a lot of our clients that are maybe new grads that maybe have just recently entered the workforce, we can still qualify potentially for a mortgage even if we have less than, say, 6 months on the job, right? So let's say, for example, I graduated from Oklahoma State in the fall. I had a 4-year degree and I started January 1st with my new employer. Well, we could still potentially qualify for a mortgage because now I have educational history as well as employment history that supports a 2-year track record. And that's what's needed for financing. Now, even if I'm thinking about switching jobs, let's say I'm on my current job for the last year and I have a new job opportunity and that new job opportunity pays more and I want to use that to qualify for my home financing. Well, as long as we have an executed offer letter, we could potentially use that offer letter to help in our qualifying. So I don't necessarily have to have 2 years on the job. I just have to show that 2-year work or educational background. Now, where it does look a little bit different from a 2-year history perspective is if I have dual employment. So let's say I'm working for one employer for 40 hours a week. Let's say I also have another employer that I do another 10 to 20 hours for. If I want to count both sources of income, I do have to demonstrate or show that I have a 2-year track record working simultaneously with both employers. So that's where that 2-year rule gets a little bit more complicated. Now, it also requires that for those that are self-employed, so maybe you're a 1099 independent contractor, maybe you've opened your own business, we do have to show 2 years of that business being active through tax filings. And being open for 2 years and file taxes for 2 years, I should say. So that's kind of where that 2-year requirement looks a little bit different. Now, if I have a 40-hour work week job, but let's say I also drive for Uber on the weekends, right, to make some extra money. If I want to introduce that Uber income and have both my 40-hour work week job plus Uber, then I have to show that I've been working with both jobs for the last 2 years simultaneously. Okay, so that's how we kind of look at income. Last thing I want to kind of share with you, because this comes up in my conversations with clients, sometimes we'll have situations where one person is going to apply for the loan, but let's say their partner actually has income that contributes to the household expenses. In order for me to use that income, I have to have that person basically be part of the loan application. We can't just add income unless they're going to be inclusive into the application. Another scenario comes up sometimes if we have room rent. So let's say I have a roommate today that pays $1,000 a month in room rent. I can't transfer that income into qualifying for my new home purchase, generally, unless I'm buying like a multi-family property, like a multi-unit property. Okay. Now you can certainly buy a home, use your own income to validate the qualifying, and then rent out a room. That's absolutely allowed. But in order to add more income to the qualifying, an existing room rate could not be used in the qualifying. Now, one of the things that we measure in looking at our mortgage eligibility is to take a look at our income versus our expenses. We call that debt to income ratio. And we're ultimately looking at our pre-tax income versus outgoing expenses, things like the new house payment, what that's going to look like, maybe my personal loan that I have, or my student loan, my credit card debt, maybe my auto financing. We take those expenses versus the pre-tax income. So if we were to look at the housing expense, for example, that's the principal and interest of my loan, property taxes, maybe the homeowner's insurance. If I'm putting less than 20% down, just like we learned tonight, you would have mortgage insurance, so that gets factored in. Maybe I'm buying a condo. That condo might have HOA fees. So those all get factored into the expenses along with those other expenses I have. So if we were to take a look at our calculation here, so in this scenario, we have a client that's spending $2,500 a month in housing expense. They have an existing $500 in debt, and they're making $8,500 a month. So in this case, the debt to income ratio is 35.3%. That means 35% of their pre-tax income is being consumed by these new expenses like the house, but as well as the existing expenses that exist. Now, when we think about that metric from a qualifying perspective, the maximum that can be is 45 to 50% pre-tax income expenses, okay? Now, the optimal level, or I would say comfort zone for most clients, is around 33 to 36% debt to income ratio. Now you can see kind of we have a varying levels, but 50% would be the maximum that we could get to. Ultimately, this is a metric to help us understand qualifying for union financing. Doesn't necessarily dictate affordability. As we build your home buying plan for you and figure out what home ownership could look like for you, we're going to talk a little bit about affordability, because ultimately that's going to be the leading indicator of what works best for you. Debt to income ratio is ultimately just a qualifying metric. Okay. Now, the last thing we want to kind of talk about in building a plan for homeownership and setting some goals for homeownership is to think about what we need to do from a down payment perspective. And so we're going to talk a little bit about savings for homeownership as well as how we document assets. Before I jump into that, did get a question in the chat. We have someone that asked a question as a first-time buyer. What income documentation would I need? And this particular attendee in class is retired. So if we're retired and, depending on what benefits we're getting, if we're on a fixed income, so, if you're getting Social Security, for example, we would have a Social Security award letter. If you're receiving a pension, we could get a pension statement along with kind of proof that money's going into your bank statement. So that's generally what we would ask for. It depends on what income you have. If you want to kind of share in the chat a little bit more about what income sources you have, we can also talk a little bit about offline. But generally, if it's standard Social Security, pension, or retirement, that would be kind of what we would ask for from a documentation perspective. Okay. All right, thank you for that question. Let's talk a little bit about down payment, because that can be one of our challenges for home ownership. So I want to kind of share with you generally what we'll ask for from a documentation perspective. So, we'll usually verify the last 60 days of, assets that you have available to you. Could that be in the form of checking and savings accounts, retirement accounts, brokerage accounts, investment accounts, could be 401ks, 403bs. If you're accessing any type of investment account, I always encourage our clients, talk to your tax or your financial advisor, because ultimately we want to make sure that you're not impacting yourself from a tax perspective, and of course losing appreciation in the equity markets. Now, gift funds can also be allowed. That's where a family member is helping contribute towards your home purchase. There is no seasoning requirement for gift funds. Other sources like own-generated funds have a 60-day seasoning period, but gift funds can be transferred right away. Just can't be cash. And ultimately with those gift funds, the donor completes a gift letter, and then we show kind of proof of receipt of those gift funds. Now, if you're still trying to figure out how you make homeownership a reality for you and just working on savings towards homeownership, you're not alone, because many of our clients are trying to figure that out. Now, there are some wonderful assistance programs available all across the country that we'll talk a little bit about tonight. But if you're thinking about savings for homeownership, I wanted to give you kind of just a thought or approach, if you will, on savings for homeownership. And it looks like this that we have on screen. So if I'm in a situation today where, let's say I'm paying $1,500 a month in rent, but I think I can double that outgo and spend $3,000 in the form of a mortgage payment, that's about a $1,500 upswing, right, in outgoing debt. Now, if I'm just lacking savings, but I know with my income I can support that $3,000 mortgage, what I would put in place as a plan is, let's start saving today like I'm paying a $3,000 mortgage payment. So on the first of the month, when I'm transferring money to my landlord for my lease, I do that $1,500, but I create that habit of taking an additional $1,500 and moving that right over to my savings account. By doing that, I create the rhythm of making a mortgage payment, so it's not like a huge shock for me once I ultimately buy my house and I'm paying $3,000 a mortgage payment. But also, you're creating savings for your account, for yourself, right? You're adding $1,500 a month. By the end of 6 months, I have $9,000 accrued in my savings account. By the end of the year, I have $18,000, not including really what a high yield interest account could get for you on top of that savings that you're contributing in cash. So that's a great way to start on that path to home ownership in terms of savings. And, like I said, that's one of the biggest challenges for many of our buyers that I work with. Now, there are first-time buyer programs available all across the country. So depending on what market you're in, there are resources that we can plug you into to help close the gap to what you need to save versus what's required for home ownership. So let's talk about what's specific to Oklahoma. So we didn't get a chance to poll our audience to see where you're at in the country, but if you do have questions in what part of the country about various assistance programs, we can certainly talk about that in class at the end, or we can talk offline if you'd like. But in Oklahoma, there's an HFA, and many states have HFAs, which HFA stands for Housing Finance Agencies. In Oklahoma, you can get up to 3.5% in assistance funds that can be used for your down payment, like the down payment for an FHA loan and or closing costs. Also, when you participate in first-time homebuyer programs, there's also lower interest rate options available to you. So when we think about traditional financing versus first-time buyer financing, traditional, say, conventional loans has adjustments in interest rates based upon what you put down. So the lesser my down payment is, potentially the higher my interest rate can be. But when you utilize a first-time buyer program, it's kind of fixed pricing. So whether I put down 3% or 20%, my interest rate is going to be generally lower. Now, there's also special incentives for teachers, first responders, and some state employees in the state of Oklahoma. So there's also some discounts that exist. Now, one of the things that we'll talk about in just a minute is our discount for Oklahoma State alumni. So because you're participating in today's class, we discount our closing costs by $750 to make affordability happen for you in home ownership. Now, we also have our Pathway DPA program, provides up to 3.5% to 5% in assistance funds. And Fannie Mae and Freddie Mac, for what we call low-income housing buyers, can also provide grants towards closing costs. So there is lots of great resources for you that we can get you connected with. We got to figure out, where do you want to purchase and what your qualifying looks like. Ultimately, these first-time buyer programs will have income restrictions, and then they're geographically based as well, too. All right. Now, let's talk a little bit about the process of buying. We're going to walk you now through our 6 steps of home buying. Now, we appreciate you joining tonight's class, and this kind of provides you the foundation of really understanding what homeownership looks like. Now, when you're ready to take those next steps and design a home buying plan, whether you want to buy in 2025 or this is a goal for the next couple of years, we want to get connected with you to put together that plan. Now, after we meet for that plan and discuss what our goals and objectives look like for homeownership, the output of that session is what we call as a pre-approval, which ultimately shows you're qualifying for financing. A pre-approval is usually good for 60 days, but we can always recertify it at any time. The application you submit to our team is always good for 2 years, so we can always, have plenty of time to design and kind of have more of a fluid discussion around home ownership, depending on when you decide to purchase. Now, that pre-approval ultimately allows you to present an offer to a seller. Now, the seller uses that pre-approval just to ensure that you are qualified to make an offer on that home. All right. Now, as you move to the next step, that is called the house hunting phase. That's where you're getting a chance to, whether search online or maybe search in person for the home that works best for you and your budget and the community that you want to buy in. We would encourage you to get connected with a local realtor. We have a network of preferred realtors that we can connect you with to help you find the right home that fits your budget and the community that you're looking for. To be honest with you, the house hunting phase is probably the longer cycle of the process. Sometimes it takes our clients 2 to 3 months. Sometimes it takes 2 to 3 years. It really just depends. But step 2 would be the next phase in the process. Now, as we get closer to kind of targeting the right home for ourselves, let's say we do find that home that works best for us and we want to make an offer on that home. Well, it might not happen on the first time. It may. Hopefully it does for you. But let's say that offer does get accepted, right? Then you're going to move to step 3. That means the seller has accepted your offer. That same day, you're going to get a call from me saying, congratulations, you did it. You have an accepted offer. And then we're going to walk you through next steps, including scheduling you for a follow-up consultation. So that's where I meet with you again on video, just to reaffirm everything that we discussed during your pre-approval consultation. Like, what are today's interest rates look like? What's your out-of-pocket going to look like? Make sure your monthly payment feels really comfortable for you and kind of give you a good understanding of what to expect next. So that's part of our follow-up consultation. Now, you as a buyer will also have action items like making a deposit on your house, which is generally going to be 1 to 2% of your sales price. Now, that is going to count towards your out-of-pocket expense. We call that an earnest money deposit. And generally, that is protected by what we call as the contingency period in your contract. Now, most home purchase transactions traditionally across the country take 30 days. Now, sometimes it can be shorter than that, but traditionally it's 30 days. Well, inside that 30-day timeline, you have what we call as contingency periods that allow you to do some investigative work on the house, like get your house appraised, which will help do as a lender to ensure the house value is supporting your purchase price. We want to make sure you get your inspections done, which your realtor will help organize to make sure the house is in really good structural condition or make sure there's no pest issues, whatever the case may be. And then we'll also get your loan approved. That's called the loan contingency that will help facilitate as your lender. That will all happen generally in the first 2 to 3 weeks of the contract period. Now, as we move through these different milestones, different actions are taking place internally with us on the lending side. Things like verifying employment, verifying your assets, making sure the loan program is designed properly. Now, interest rates will move during the course of your transaction. So one of the conversations we're going to have is when to time the interest rate lock for your loan. So when you go under contract with a seller, we lock in your interest rate to make sure your rate is secured at whatever market rate we select on that day to get you through the duration of your home closing process. Now, there is some strategy to that, especially in today's market where interest rates can kind of bounce all over the board. We'll help educate you through that during your follow-up video session just after step 3. Now, as we move through each one of these milestones, you're receiving electronic disclosures with your initial disclosures within 72 hours of your accepted contract. Once you have a interest rate lock, then we send another revised set of disclosures. And then finally, when we get to step 5, you're going to get your final closing disclosures, which give you a 3-day cooling off period before we get to the very final milestone, which is step 6. Now, at step 5, we've now obtained our loan approval. We probably have your appraisal back for your home value. And so we're putting the finishing touches on everything. Now, you're also probably at the end of your contingency period. So if you're feeling pretty comfortable about the house based upon all the work that you've investigated on, home value obviously checks out, your loan's good, then we're going to sign off on our contingencies, which will tell the seller that we're ready to move to the final stages of the process. Now, just before we get to the final stage, we're going to issue that final closing disclosure for you to give you a 3-day cooling off period before you sign final loan documents. That happens in person. Everything for the most part can be done electronically, but step 6 is still doing things in person. You're going to sign final loan documents with either a public notary or attorney, depending on what state you're in. On that same day, you're going to wire in final funds for your home purchase, whatever funds are still remaining for the transaction. Then as a lender, we wire in your funds for your home transaction. Those funds get all balanced out, and then the escrow or attorney team records documents with the local county recorder's office. They record generally a grant deed, which will transfer ownership to you, as well as the deed for the loan. And once that all happens and we have recording confirmation, then we get a chance to celebrate with you because guess what? Now you become the new homeowner. And that's a huge day of celebration. I get a chance to make at least a few calls like that a day. Huge accomplishment for our home buyers, and we couldn't be more happy when our clients get the keys to their home because it's a huge financial milestone, right? Now, our relationship doesn't stop after you get the keys to your home. Part of our aftercare program is we want to be there every step of the way for you as you grow into home ownership, right? So as interest rates go lower, we can help you with refinance options, and we kind of track rate options for you through our rate watch system. We also send out our HomeBot notification system, which kind of tells you what's going on with equity in your home and ultimately appreciation in your home. And we're always checking in with our clients on an annual basis because let's face it, things change over the course of our lives, and we want to just make sure that you're informed with all the resources that are available to you as homeowners. All right. So that's what the home buying process looks like. Now, after leaving tonight's class, if you're interested in building your own home buying plan for homeownership, I would love to meet with you to discuss really what homeownership could look like for you. I've had the pleasure of meeting with your fellow alum throughout the year and designing their own home buying plans, and we'd love to be able to do that for you as well. It is a simple process to get started. It includes just a really easy online application. We only do a soft credit check, so you're not worried about impacting your credit score, and then you upload documents and then use our scheduling system to schedule your free consultation. So it's absolutely a free service we provide. You don't have to feel rushed to go out and buy a house too either. It could be something you want to hit as a goal for this year. It could be something down the road, but we just want to make sure you get all the right information. Here's what's included in your consultation. Where do I want to buy? What's my budget look like? Are there opportunities maybe for credit improvement? What product is going to match up best for me? And maybe I need to participate in some first-time buyer programs. We'll discover all of that stuff as part of your consultation service. Last thing I just want to touch on before we wrap up tonight and maybe take some questions before the end. This is one of our mobile resources. So if you're thinking about applying, you can do that via mobile. You can also follow the progress of your loan right via mobile. We can also use the calculator functions, which a lot of our clients use, just to kind of figure out, like, if I'm at an open house, what does the payment look like on a particular house? It's, of course, available for Google or Android and Apple devices. Just want to again spotlight how proud we are about our partnership with Oklahoma State alumni. Really excited to be able to help explore homeownership for all those as part of the association. And because of that, we do pass along that discount available to you for a $750 credit towards your closing costs. All these resources that we provide to you are all free resources to make sure that you have the right information in making this major financial decision. And last thing I just want to share with you is, if you do have friends, family, coworkers in your community that think would benefit from these resources, you can see some of our classes, or I should say our partnerships that we have across the country. But these are truly free access points to help educate in homeownership. We understand challenges out there in the market around affordability, and I think it's important to understand really what your resources could look like for you whenever you decide to make that financial decision. Well, I want to thank you again for joining me tonight in our discussion. Hopefully you found this information to be helpful for you on your journey towards homeownership. Here's all my contact information. If you'd like to get connected with me, feel free to book your free appointment online. And we've included all of our social channels. As I mentioned, this class will be up on our YouTube channels tomorrow. So if you want to kind of look back at some of your notes and go through our discussion points, you can see that up on our channel. Okay. Well, I'm 1 minute before the top of the hour, but I will certainly stick around for any questions the class has. So feel free, if you do have any questions for our class, go ahead and drop those in the Q&A or the chat, and I'll answer those before we get wrapped up. I know we got a few of you hanging around there. I know I'm either, depending on what time zone you're in, I'm just before dinner, I'm just slightly after dinner. Maybe I'm in the middle of dinner, but want to make sure we don't take up too much more of your time. I do appreciate everyone being a part of tonight's discussion. Okay, everybody's, I'm waiting around. So if anybody's typing away, I'm sitting here waiting. So no worries at all. Take your time. Okay, I think we might be good. All right, I think I don't see any typing away. So I do appreciate everybody joining tonight's class. I hope I get a chance to meet each of you and help you in your pursuit of homeownership. Have a wonderful evening and enjoy the rest of your week. Good night.